In this video, I'm going to show you how you can arbitrage in cryptocurrency markets and make between 20 and 40% APY with zero downside risk. We've all heard of these lending platforms like Nexo, Pocket, Celsius. They give you between 10 and 12% APY on your stablecoins. So that's a guaranteed 10 to 12% you're getting every single year with zero downside risk. How do they make money? They take your money, lend it out themselves, and keep the profit. So instead, I'm going to teach you how to do this for yourself, so you don't have to deposit your money into places like these. So first we need to know what margin trading is. Margin trading is borrowing money from an exchange using leverage and that giving us more purchasing power on our money. So in order to trade margin, we need to deposit collateral. Collateral is the thing you give an exchange as security of what you receive. So for example, if you were to go and rent a car for the day, you would have to deposit a safety deposit. Let's say, for example, $500, and that $500 would be collateral. That if something goes wrong with the car, you crash it, for example, the dealership has the right to keep that money. Or if you want to take a loan out from a bank, you could use your house as collateral for the loan. So if you fail to repay the loan, the bank has the right to take your house. In the same way, when trading margin, we have to deposit collateral. There's two main types of margin: coin margin and stablecoin margin. Coin margin being where you deposit a cryptocurrency, in most cases it's going to be Bitcoin, and stablecoin margin being where you deposit stablecoin, for example, Tether or USDC. Now there's many different types of margin contracts. It's important to remember that all margin contracts are considered derivatives. That's because their price varies from contract to contract, but regardless of the contract, the price of the contract is derived from the price of Bitcoin. So therefore it's considered a derivative. For this video, we're going to be focusing on Binance. On Binance, the first thing you do is you select the form of margin contract you would like, whether it's a stablecoin margin or a coin margin contract. That's going to be the collateral you offer in exchange for the margin you're going to receive. Within that, we have two types of contracts: perpetual contracts and delivery contracts. But for this video, I'm going to refer to delivery contracts as futures contracts. Depending on which contract you select, every contract has a different price, which is important to note. Now let's focus on comparing perpetual contracts and futures contracts. It's important to understand the difference between the index price and a mark price. The index price is the actual price of spot Bitcoin. Index price is the average price of Bitcoin divided by the volume across all the exchanges. The mark price is the price of this specific contract on this specific exchange. As you can see, the price between the two contracts is different. The mark price on the futures contracts being significantly higher than the mark price on the perpetual contract. The other main difference between the two contracts is that perpetual contracts pay something called funding, whereas the futures contracts don't pay funding. It's important to know that exchanges want to keep index price and perpetual margin contracts price as close to each other as they can at all times. In order to do so, they deploy a mechanism called funding. This mechanism encourages people to enter short positions when the market is overbought. At the same time, it will also further discourage people from longing in overbought situations and discourage people from shorting in oversold situations. Funding rate varies from exchange to exchange, and also the funding payout time varies from exchange to exchange. In Binance's case, funding is paid out every 8 hours. Due to the fact that futures contracts don't pay funding, they trade at a higher premium than a perpetual contract will. As a result of this, futures contracts expire every quarter. Every contract will be dated differently. This contract, for example, expires on the 25th of March. Now that we covered the differences between the two contracts, let's recap them one more time. Spot refers to the actual underlying asset itself, so in this case Bitcoin. So we can see that perpetual contracts don't expire and futures contracts do. Perpetual contracts pay funding and futures contracts don't. Perpetual contracts don't trade at a premium, or be a very small one, whereas futures contracts trade at a very large one. Spot, Perp and futures contracts all pay these. Maker fees refer to the fees paid when using a limit order, and taker fees refer to market orders. And as we know, perpetual contracts and futures contracts are both derivatives of Bitcoin. So how can we use funding in a market neutral way? First, let's compare funding across the different exchanges. For this instance, we're going to focus on Binance. We can see that we're collecting 0.06 every 8 hours. So over a day, we'd have to times this number by 3, and that's the funding we collect over the day. So how could we use this in a market neutral manner? First thing we'd have to do is we'd have to purchase a spot of the asset we want to. So in this case, let's use Bitcoin. We'd enter $100,000 spot purchase of Bitcoin. At the same time, move this spot Bitcoin to our margin contract position, where we'd enter a perpetual short position for $100,000. This would be considered a market neutral opportunity. Whether the market moves up or down, our net position will still be zero. Let's assume for this day the market moves up 10%. Our spot position will be in $10,000 of profit, and our perpetual short position, would be in $10,000 of loss, meaning our net position would be zero, meaning overall we'd still be operating at $100,000, the same we started with. However, during this 24-hour period, we've collected 0.06% of funding every 8 hours. In 24 hours, this works out to 0.180% of profit. During that net neutral position, we've accumulated $180 risk-free. Same way, if the market moved down 10% that day, we'd still be net zero and we'd still have collected this funding. Going on to Binance, we can see the live funding rates on the exchanges for all the coins. It's important you're on coin margin, as you'd already have purchased a spot crypto asset, as that would be your collateral for the short perpetual contract margin position. Here's the calculation for funding rate. It's important to know that premium index mostly remains at 0.01%. So even when the market is neutral, funding will still stay positive by 0.01%, as it will most of the time. Going to Binance, I've extracted the funding rate for the past 11 months. When you total this all up, it equates to 22.95%. So that's for 11-month period. For a 12-month period, at probably 23-24%. So that's 24% you can make absolutely risk-free just from holding on perpetual contracts. Bear in mind, this is different for every asset. So for example, funding on Ethereum is usually higher. So on Ethereum, you're probably getting 25-26%. And this varies to year. The more volatile the market is, the higher this percentage is going to be. It's important to also note that there will be periods of negative funding as well, in which case you would need to close your positions. When you add this all together, you're probably looking at 27-28% APY, including the management of positions. So now we've covered how we can make profit using perpetual contracts, cash and carry trades. Let's cover how we can make money using futures contracts on cash and carry trades. As you can see, the deviation between the mark price and the index price is quite large here. So we can use this to our advantage to profit from it. As people purchase futures contracts to avoid paying funding fees, this artificially drives the mark price up. However, due to the fact that the contract expires, mark price will inevitably drop closer to the index price. However, as the market moves closer to its expiry date, the mark price will inevitably drop to the index price and eventually trade at a premium of 0%. As you can see here, the futures contract which is closer to expiry trades at a lower price than the futures contract which is further away from expiry. As these contracts get closer to expiry date, they will eventually trade at a 0% premium. Here I have the percentage premium of a deribit future. As we can see, it's a downwards trend. So knowing that the closer we get to expiry, the closer the premium will get to zero. So how can we use this for an arbitrage opportunity? In this case, there's a 4.5% premium between the mark price and the index price. What we would do is purchase our spot Bitcoin, move it to our coin margin account on Binance, and enter a short position on the contract. Now knowing that our future short premium would eventually go to zero, our short position would be in more profit than our long position, meaning we have a guaranteed 4.5% profit on this trade, at the highest case scenario being in 132 days. However, in multiple instances, the premium will go to zero before the day of expiry actually comes. In some instances, you will actually be able to enter multiple arbitrage opportunities. Here, for example, you could have shorted at 5%, closed the position at 1% for a 4% gain, reshorted at 4%, it closed for almost 0% here, which would have been another 4% gain. Reopened here for another 1.5% and closed here again for 0%. That's almost 10% profit in a cash and carry trade over the period of one quarterly contract, which works out to roughly 40% APY. Now combining what you know of the perpetual contracts, cash and carry trades, and the futures contracts, cash and carry trades, it's up to you to find when the market offers the most opportunity and determine which trade you will enter. With no effort, I've shown you that you can achieve 25% APY. But if you look close at the market, you'll see that you can easily get up to 40% APY just from keeping an eye on things. One extremely important aspect of cash and carry trades is you need to understand the fees. Earlier we spoke about make and taker. Maker fees is the fee you pay when you enter a limit order, and taker fees are the fees you pay when you enter a market order. Depending on the contract type, you will pay different make and taker fees on each different contract, and each exchange will have different make and taker fees on each different contract. It's up to you to find which exchange suits you the most depending on where you live in terms of fees to maximize profitability. When entering a cash and carry trade, you're going to pay a 0.1% fee on your spot purchase. Now moving to coin margin futures trading, you're going to pay a 0.05% fee when opening your short position. When you then close your short position, you're going to pay another 0.05%. After you close your short position, you would then be back into spot, in which case you would need to again convert your Bitcoin back to stablecoin, which would be another 0.1%. So over the course of the trade, you're paying 0.2% in fees on your spot, and you're paying 0.1% fees on your coin margin contract. So overall, you're looking at 0.3% in fee. So you need to take these into account when entering cash and carry trades to ensure that your trade is going to be profitable. Here are the different make and taker fees for spot trading only, amongst the different exchanges. It's also important to note that Bybit most of the time is going to have the highest funding rate amongst all the exchanges. So what are the catches? It's important to remember that when the market is more volatile is when funding and premium indexes on margin contracts are going to be at their highest. So you're going to be missing out on possible gains in the market during these periods. The other catch is that money must be kept on an exchange, rather than cold storage where it's at risk of being hacked. If you found the video useful, please leave a like and subscribe. And you can join my free Discord where I post analysis. The link will be in the description.